So good morning, everyone. Welcome to session 10 on cryptoeconomics. It's my pleasure to introduce the first speaker, Gordon Liao. He's the chief economist at Circle. In addition, he also advises Uniswap Labs, and Gordon holds a PhD in economics from Harvard University. He'll be presenting on-chain foreign exchange and cross-border payments. Welcome.
Thank you so much. Well, thank you for the organizers for including this paper. This is joint work with my colleagues at Circle and Uniswap Labs. And this is an empirical paper looking at a very interesting market that I think is the first area in which applications of blockchain and decentralized exchange could actually take off in a meaningful way. And that is the foreign exchange market. So first I'll go over some motivation behind this paper. The FX market is substantial, around $8 trillion per day of volume. And that is also a very large cross-border payments market, roughly representing a couple percentage points of GDP that's being transacted on a daily basis. Now, a substantial amount of FX transactions have settlement risk, which is a fundamental issue that many regulators and traditional financial institutions recognize. Roughly $2.2 trillion a day of FX trading are unprotected from these sort of settlement risks. And the typical way of protecting from settlement risk is through netting of trades. But this is insufficient because there is a cost to netting. Therefore, there is a fundamental reason why you see now many more regulated institutions, such as the Bank of International Settlement, are experimenting with on-chain FX, and specifically for settlement risk reasons. In addition, there is a huge cost to certain type of FX transactions. For trading, usually the costs are very minimal. But for something like remittance or even small business payments, the cost could be substantial, which could average around 6% for global remittance. That is the value of transactions. The second motivation behind this work is looking at market making and exchanges from a lens of a traditional finance market that we understand very well. We understand how the market behavior works. And we could make a comparison between the traditional FX market and the AMM market for stablecoins that are in different currencies. So let me just start by talking about how corresponding banking works and why there's a lot of friction. So typically, when you send money from one country to another, such as from the US to the Eurozone, you actually go through multiple ledgers. From country A's perspective, there's a country A's payment system, and the ultimate ledger on which money are kept are with the central bank. That is, the sender's bank have to settle with other banks, which are known as correspondent banks, on the ledger of the central bank. That is one set of domestic payment system. For that country's bank and sender to interact with a different country, you have to go through a corresponding banking network in which the correspondent banks have access to multiple ledgers, in this case, the settlement system for different central banks, such as the Federal Reserve and the European Central Bank. And there's a separate messaging layer. This is a SWIFT system in which the majority of something like 99% of FX transactions still go through, which is a very archaic layer of messaging infrastructure only that is separated from settlement. Now, how does it work in decentralized finance with FX transactions? Well, for this audience, I don't have to explain too much about DEXs, but I do want to point out the critical differentiation is that the transactions are occurring without pretty much leaving the user's wallet. All the transactions are atomic. The one step of friction in this process is the on-ramping and the off-ramping. That is, in this graph, the step one, as well as the last step. that part is usually the responsibility of a stablecoin issuer, such as Circle. But once it is on-ramped, we can utilize everything that has been built in decentralized finance. What are the comparisons of market features? So I could go through each of these, but I think for this audience, most people are familiar with the features of decentralized finance. But I would say that the important parts of traditional financial market frictions do play out in a very significant way in terms of additional settlement risk that historically has been a problem plaguing the FX market, as well as things like benchmark rigging in FX. So I guess Oracle attack is not just limited to decentralized finance, rather it's actually a real problem with traditional price oracles of sorts. In addition, there is fraudulent activities that historically have plagued the FX market. Also liquidity issues. Flash crashes in the traditional FX market is actually fairly common, usually occurring in the hours between when New York closes and when Asia opens. And those type of flash crashes historically have raised a lot of issues with both regulators and market makers. Now, I think on-chain FX could potentially be a solution to many of these problems. So in this study, this is an economic study. So what do economists care about? Well, do the demand meet supply? Does it work for the liquidity demanders, liquidity suppliers? And is there a price discovery that's sufficient? So first, I'll start with the demand side. This is the daily volume for the USDC Eurocoin 5 bips pool, which was deployed around last year, last August, around the same time that Eurocoin, which is a stablecoin pegged to the euro, was launched. So far, trading volume has been relatively small, with a mean of 500K, median of 250K per day. But the max is 8.5 million. I think I'll go over why there has been adoption challenges later and what are the missing pieces, primarily associated with the on-ramping and off-ramping part. But this is potentially a market that could grow, and there is some level of trading. Now, I say there is a large market to be served because even if this market is not serving the institutional clients as looking for super tight spreads, there remains a very large end-user market. Remittance, for example, is a multi-$100 billion market per year. Business-to-business payments also occurs in the trillions of dollars. But those markets are underserved because the cost for those end users are oftentimes greatly exceeding what one could get on traditional exchanges. So this is another example of the share of GDP from remittance. Oftentimes, for some countries, is a substantial portion of their domestic economy. If you're looking into cost comparisons, I don't think AMMs are yet at the stage of competing competitively for trading purposes that are speculative trading purposes. But for end user, such as remittance or business-to-business payments, and this is a graph where we calculated the payment of remittance costs for around, I think, $250, using World Bank numbers for banks, money transfer operators, and then using the gas fee and on-ramp cost that we can get based on the Uniswap protocol for this specific pool. There is substantial saving when it comes down to end-user cost comparisons because there is quite a bit of intermediary fees that are added on top of trading fees. So in this paper, we have a range estimate of what these transaction fees look like. And you could reasonably argue that, at least for the purpose of end-user peer-to-peer usage, as well as even business-to-business usage, this could potentially be quite competitive. Now, let's move into the more interesting part. Does this work for liquidity suppliers? And I asked the question of, are FXLP sufficiently compensated for the adverse selection? And there's a lot of work done in this area in general for AMMs, but I think the FX context is very unique. So this is probably just background information for this audience. We understand how fees are accrued to liquidity providers is based on both the transaction volume, which is how much of the sum of delta y is being exchanged, as well as the fee percentage. So usually it's 5 bips or 30 bips, and that could range with volatility, and the divergence loss. What's unique about the foreign exchange market is the volatility is very low. Generally speaking, annualized volatility is about 10%, which if you take any sort of expected absolute return, so if you price it as a straddle, for instance, on the any type of FX pair, you're getting an average absolute return in annualized around 8%. That means the divergence loss is really not the whole curve, but generally speaking, it's around this very flat part, minimum divergence cost. So for AMMs, recently there's been a lot of papers on lever, this measure of loss versus rebalancing. So how does it look like for these FX pools? Well, this is the calculation that we've done for the Eurocoin USDC 5 bips pool. You can see that, generally speaking, this is actually a somewhat profitable pool, even on 5 bips and not too much volume in the trading. So we think this is quite interesting from a liquidity supplier perspective in that it actually makes sense for liquidity suppliers to be in this market. Now, why does it make sense that adverse selection could be sustained in the foreign exchange market? Well, generally, you need enough uninformed trading to generate fees. And informed trading, in this case, is heavily reduced because of the mean reverting nature of prices in FX. FX market is fairly liquid and fairly transparent, and there's not much of an information advantage, unlike some of the long tail markets. In addition, there's a deep theoretical reason for why FX returns are somewhat mean reverting, and this is the classic econ theory of uncovered interest rate parity, which holds somewhat true in data, but not always. That is, the expected return on the FX rate is related to the domestic interest rate minus the foreign interest rate, so the interest rate differential. Now, given that global interest rates are oftentimes co-integrated due to the synchronicity of monetary policy globally, FX rates tends to be somewhat range-bound. That is, it is good for the LPs. So this also relates to a very large econ literature about holding the same fee, higher the autocorrelation in returns, the more loss to the market makers. So what do we observe empirically? We observe that liquidity providers are fairly passive. That is, 85% of them hold their positions in these FX pools for longer than a day. But there are some liquidity providers that are active. So this is an animated graph from my co-author, Alston Adams. And this kind of shows that at the base layer, there is a certain amount of passive liquidity that is always there. But there's some rebalancing, but it's not rebalancing as frequently as perhaps the ETH USDC pool. And in part, the rebalancing doesn't have to be as fast because the volatility in FX pairs are relatively tame. So that goes back to the liquidity issue. How consistent are the liquidity, given that we observe these sort of dynamic between passive liquidity providers that's always there providing liquidity and somewhat active liquidity providers? By and large, a liquidity provision is relatively passive. And that's where we observe that the market depth fluctuation over the course of an average week is not so substantial. So this is the plot of, I think it's 2% market depth, but it's taking as a mean, as a difference between the average market depth. So you can see that between, say, the busiest trading hours of Monday morning New York time versus the quiet downtimes of Saturday evening or something, it's fairly consistent in terms of how liquid this market is. Now, this might not be very surprising for those who understand how DEXs work, but for those who are in traditional finance, this is actually quite shocking. Because in traditional finance, people understand that market liquidity kind of disappears in certain times of the day, and especially for FX, it almost evaporates entirely during certain market hours, and especially on the weekend. So this brings me back to the last point of this presentation, which is about, is there sufficient price discovery? And how is price discovery done, both during the weekdays and on the weekends? One interesting aspect of this empirical study is the weekend volume is quite substantial, even though so this is the average volume over the course of the week when we average all the data together. And you can see the white bands are the market hours during New York, and the gray zones are, I believe that's in the non-New York, non-European market hours. So you do have fluctuations in volume. And coupling this with the earlier liquidity graph, you can actually tell a story of even though the demand volume is fluctuating all the time, the liquidity supply is quite consistent. This is just from a traditional FX market structure perspective, quite surprising because it is not what you would expect. But what's also interesting to highlight is the period of time between when Friday market closes, typically in the FX market, and Sunday when market opens. That's the last bit of this large gray band, which on average is about 20% of a weekday volume. So this is also a very surprising fact because typically FX market just completely closes. It's almost no volume being traded during the weekend. And the fact that we observe that on AMMs, there could be something like 20% of weekday average volume says something about perhaps if this market opens up broader to a wider set of users, it could actually generate fill this gap that's missing in the traditional FX market, which could be 20% of the weekday volume. So earlier I spoke about price discovery and how that is typically done. For AMMs, generally it's enforced by arbitrage between centralized exchange and decentralized exchange. And this is how typically we think of pools like ETH USDC as arbitrage and prices are enforced. And that seems to apply very well in this context during the weekdays when the centralized exchange or the external oracles for FX is operating. This is a plot of the Eurocoin USDC pool against a Bloomberg fixing that's every half an hour. And these are fixings that many derivative contracts are actually written on. So you can see that typically they are within a couple of bips of each other. It's not exact because this is a 5 bips pool. So for the adjustment to happen, you need the price differential to be greater than 5 bips. To incentivize arbitrageurs to come in. What I want to focus on in the remaining time is looking at can there be independent price discovery without arbitrage against centralized exchanges, which is typically how AMM function. And I think in this setting, the FX market is really fascinating because it's one of the only markets in which there's a large volume that's trading during weekdays, and then during certain periods of time, namely during weekends, the entire market kind of shut off. But then on Monday, it springs back up, or on Sunday night, the market comes back alive again. So it's a very good testing ground for do AMMs help with independent price discovery during the period of time in which there is no liquidity in the centralized exchange market. And pretty much all the traders go home and the FX market shuts down. So what we could look at is, does the on-chain FX return from the New York Friday close to, say, Sunday, New York at noon, which is a period of time where presumably there's still some information being impounded into the market, into the AMM price. But the entire FX market is shut off on the traditional finance side, so there's no return signal, there's no Oracle price to go off on for any sort of arbitrage type of price discovery. So if we believe that there is independent price discovery on AMMs, then the return on, from Friday close to Sunday at noon on the AMM should be predictive of the overall period of return between when market closes on Friday and when market opens again on Sunday evening in the traditional FX market. And that is assuming that when traditional FX market opens is much deeper and prices adjust, and that is reaching a sufficient fundamental price. So what we observe is there's actually quite a strong predictability, meaning that there is sufficient amount of independent price discovery on AMMs. And this is, I think it's a result that's beyond the FX market. I think this is a fundamental test of can AMMs facilitate independent price discovery. This is a test that's not easily done because usually if you look at most of the crypto pairs, ETH pairs, and et cetera, those are always arbitraged against a 24/7 centralized exchange. And the FX market is one in which you could actually test this. Periods of time when the AMM is working, but centralized exchange is not working, and when the centralized exchange comes back up, does the price align? So there seems to be some predictability that is perhaps signaling that there is independent price discovery on AMMs. So I said earlier on that the volume of this market hasn't been very large. It's kind of growing and still on the smaller side. What are the missing pieces? So here are a couple of areas, and in this paper we're actually going into a bit of detail about areas in which essentially are both missing pieces for the market to develop, but potential opportunities for entrepreneurs and startups to actually go into. One is the regulatory clarity on the application of DeFi. That part we can't really do much about. But the others, I think, are areas that could be fruitful. On-chain decentralized identity solutions is absolutely, I think it's necessary for this FX market to take off because it would be a more regulated market. Even though foreign exchange is rather decentralized in the sense that it's not operating on any single, not operating in any single jurisdiction or any single exchange, most countries have some rules about identity for foreign exchange. A safe custody solution, yesterday we had some talks on MPC wallets. Perhaps that is a major missing piece for actual adoption of this market. I think having a robust set of derivative instruments, forward instruments, are also a critical missing piece. Because if we look at today's foreign exchange market, the bulk of the volume is actually on the forwards. They're not on the spot transactions. The spot transactions probably 25%, 30% of transactions. But the forward market, which in some sense is in the crypto space is taken over by perpetuals, is one missing piece of developing on-chain foreign exchange. And then addressing issues such as MEV and fund running for institutional use cases. So I'll conclude here that this overall study is a study that merges between our conception of decentralized exchange and AMMs with a traditional market that people understand and there could potentially be large adoption. In this paper, we'll go through quite a bit of the current challenges facing traditional finance and the potential on-chain FX benefits, as well as we listed out the demand side and the supply side considerations for whether the market could develop further. So I'll conclude here, and we'll take any questions. Thank you.
Test. Thanks so much for the great talk. I do have a quick question. So You highlighted remittances as a potential application, but in many cases, these remittances are sent by workers like who are not necessarily, who do not necessarily have technology literacy. So, do you think there will be hurdles in adoption of DeFi tools by workers for foreign exchange? And also, can you elaborate a little bit on like the regulatory risks that are involved with cross-border payments?
Sure. The first question is on adoption by brokers, and second one?
Yeah, like especially in the case of remittances.
Okay, great. I do think there is a potential for brokers to adopt this technology, but not at the current state, because right now the prices are relatively high for institutional use cases. Even paying 1 BIP is relatively high for FX standard. And now the main pool is at 5 BIPs for these sort of FX pairs. But eventually, you could potentially see a world in which brokers come in and use this as almost like an inter-broker market for especially during times when there is liquidity shortage in traditional order book type of setting. So this could supplement the traditional OTC market because it is an area where you could get the passive capital coming. Brokers typically have high return hurdles, and therefore their capital is limited. But if you can bring in the institutional capital, such as pension funds of the world and FX reserve managers of the world, that greatly increases the amount of liquidity, and they don't need to have as high of a return hurdle to overcome. Therefore, you could attract a lot more capital in there, and those would be passive capital that's actually could be available for brokers. At this point, I think the core area of adoption would be end-to-end users. That is, in the case of remittance is one example, but I think even for business payments, if you're paying employees every month in a certain normal range of tens of thousands or hundreds of thousands, that's an area where using this sort of technology, you could actually reduce transaction costs, but you can overstep some of the intermediation fees.
Thanks so much. Let's take a question.
Yeah, so thank you. So the question that I had was, you mentioned settlement risks as one of the problems of traditional foreign exchange markets. And I wanted to know if in the paper you have some kind of estimate to know whether it's high or low, like expected loss, not just like an exposure of like trillions of dollars that are being traded in a day.
Yeah, so this is an area measuring settlement risk typically is done through just mostly through exposure. That's because this market is, when settlement risk, when trades fail, is catastrophic. Historically, there's been a couple of times when the settlement in the FX system completely freezes up, and it's actually a pretty bad global issue. So most of the time, nothing really happens, so it's hard to measure. But the exposure is there, and the exposure are disclosed. And that's what oftentimes people focus on, how much exposure countries have or broker-dealers have.
Thank you.
So we need to go into the next session, but perhaps you can find the speaker afterwards. So welcome to the second talk of session 10 on cryptoeconomics. It's my great pleasure to introduce Professor Noam Nissan. He does not require much of an introduction, but I will still try to do my best. Professor Nissan is a professor at the Hebrew University of Jerusalem. He is also a principal researcher at Starkware. He is known for his research in computational complexity theory and algorithmic game theory. And he is a recipient of the Gödel Prize, Knut Prize, and EATCS Award. And he will be presenting serial monopoly on blockchains. Welcome.
Thank you. So good morning, everyone. Thanks for coming so early on the last day of the conference. Why is this not working? Okay, so we're talking about sequence of blocks. Every block has a leader, a miner, a validator, a sequencer. And the important point is that the leader gets to decide what goes into the block. And what wants to go into the blocks? Well, we have users that want to send their transactions into the block. So in a sense, every leader basically is selling the block space to the users that want to use it. And we have basically, our leader for the certain current block is, if you wish, a monopolist for this block specifically. So he's not a monopolist forever, because for the next block there's going to be a completely new leader. But he's a monopolist for this, 10 seconds, or I'll talk about it as a day. He's a monopolist for today, and tomorrow there's going to be a different monopolist. So that's our setting. And the basic setup, the users want their transaction to be on the block, or basically the users want to buy block space from the leaders. But there is going to be only limited block space, and so we want to make sure that the most valuable transactions are the ones that get this block space. And we need to somehow define a mechanism, the fee mechanism that decides what gets onto the block, what is the rule according to which transactions get onto the block, and how much do they pay. And the reason we need like a mechanism for that is the fact that everyone is strategic here. So the users, of course, want to pay as little as possible fees, and they want their transaction to appear in the block. Also, the leaders are strategic. They want to make as much money as possible, and they can do lots of things. And of course, by the way, there's also very possible to have a coalition of a leader and a bunch of users, or a bunch of fake users. That's also very easy in our setting. Okay? So how one does it? How can you do that? So there are like two classic, if I can use the term classic in this space. So the first one is pay your bid, a first price auction. Every user suggests, I'm willing to pay $7 for my transaction, and then the leader comes and collects all the highest paying transactions until he fills his block space. So that's sort of incentive compatible for the leader, because the leader does the best things that he can. But of course, users need to sort of guess what is the lowest price that they can offer and still get into the block. So it's not what's called incentive compatible for the users. The users need to do strategizing, and it's inconvenient for them. It's a bad UX. The second option, the second classic possibility, is what Ethereum does. And basically, the trick here is that the price for gas, or for the capacity of the block, is fixed before the block starts. So neither the leader doesn't get discretion in choosing the price, but somehow it's determined according to some function of previous blocks in a way that sort of tries to find the market equilibrium price. And once you get that, now it's incentive compatible for everyone, because users, there's just a price, so if they're willing to pay it, great. If not, they're not. And the same thing is true for the leader. He wants to take as much possible into the price. But there are a bunch of caveats there. So you need to burn payments, otherwise you open the possibility for collusion. The block size need to be variable. That's how the price setting mechanism works. And you also need this tip kind of thing, that with some extreme cases, you need to resort basically to a first price mechanism. So it's sort of complex, but most of the time it works in a very incentive compatible way. So I'm not going to talk about these two mechanisms. I'm going to talk about a third suggestion that is not really used as far as I know, at least not used much, but it's been proposed by at least these two papers and probably more. And it basically says, let the leader choose the price for his block, any way that he wants. Okay? Now, so let's see what happens. So from the point of view of incentives, the leader, of course, now he gets complete freedom. So the only thing we restrict him is, and the protocol can restrict him, you must charge the same price from every transaction in your block, per gas or per whatever you count. And so the leader now gets to do the best thing for him, that's clear. What about users? The point is if users are small enough, so if I'm a user I am small, so I'm not going to be the last user in a block in a certain sense, then I'm also not affecting the price that the leader charges. And in that case, if I'm looking at the current block or only what's called myopic, and I'm small in the sense of being a price taker or not affecting the price of the block, then it's also incentive compatible for me. So that seems very nice. It's a very simple mechanism, sort of incentive compatible for everyone. And so how much do we like it? And of course, these papers formalized exactly what does it mean being small and what does it mean being almost incentive compatible, and that sort of is the case. But intuitively, I think it's clear from the way we're describing it. So let's see what happens there. So okay, as we said, the good thing is things are sort of incentive compatible. The major problem with this is that monopolists don't have any incentives, the leaders don't have incentive to really fill up their block to the capacity of the system, but they will choose some intermediate price, what's called the monopolist price, like monopolists usually do. They will decrease supply and in a way that maximizes their gains. Okay? So that's sort of a significant loss of efficiency of the whole system, and that's something that you lose. Now, there's another thing is that they get more revenue. So the way we actually set up the system is that the leaders get as much revenue as they can, and that can be good or bad. So it can be good because you get more security from fees and not just from block rewards. It can be bad because of the same reason. So you have to decide. Okay. So that's basically the analysis that was done. And the important point here that I want to focus on is this myopic kind of thing. All this analysis, by the way, like most analysis that people are doing for fees on blockchains, looked only at the current block and looked at as though everyone just wants into this block, and if it doesn't get into this block, it doesn't care at all what happens tomorrow or in 10 seconds, realistically, right? So I'm going to look at the opposite. And figure out that, realistically, transactions that did not get into this block remain in the mempool, and they, compete again for the next block and the block afterwards and so on. And I'm going to focus on probably the most common situation where a transaction really doesn't care if it's now or in half a minute. Okay, that's not the universal case. So definitely some DeFi kind of applications really want to be in this block, and the next block is no good for them at all. But for most normal applications, the time difference between blocks is not that important for the user. So that's what I'm going to look. And the point that we're trying to think is that maybe under this kind of analysis, the situation is not as bad, that the monopolist really decreases the supply and decreases the throughput of the system. Why would we think that this may not be so bad? Well, suppose that I chose some arbitrarily, I'm a leader today, I chose some arbitrarily too high a price. Then what happens that the next person tomorrow, the leader tomorrow, will see more demand at lower values and only a little bit new demand at higher values, so he will decrease the price. So one could assume or hope that somehow the prices over time will go down to a lower equilibrium, which does not waste too much bandwidth. Okay? So that's the point of view. So we try to analyze basically this dynamics. So what I'm going to do here is simply try to analyze, okay, what exactly happens when some demand that was not supplied because of high prices remains in the system, and tomorrow we see a little bit of new demand and the pent-up demand from today, so the prices change. How does this dynamic work? That's just what I'm trying to analyze here. So here's a model that does that. So we're going to have every day a new demand comes. And that demand is going to be given by a function Q of P, which means how much new quantity of demand do I have at a price P. So this is going to be, of course, a decreasing function. The higher the price, of course, the less demand you have at that price. At a very low price, you probably have a lot of new demand. Okay? So Q of P is a function that's going to be the new demand that comes every day. And we're assuming that each block has exactly a fixed amount of supply, so we'll call it S. And by the way, I'm choosing explicitly the simplest possible model that you think, because I have some kind of phenomena that I want to demonstrate. So this is a very, very simple model that already will have this weird phenomena. And so notice that this model basically is completely deterministic, nothing stochastic in it, no variable demand. Everything is completely fixed. The new demand every day is exactly the same. Everybody knows it, nothing to worry about. So what happens every day? Every day, you have some pent-up demand from previous days. You have the new demand, Q of P. And then your demand at day t, which I'm going to denote by dt of p, is a function. At every price, you have a certain demand. That's basically just the sum of the pent-up demand from yesterday together with the new demand of today. Okay? And then the monopolist, the leader, basically chooses the best price that he can. So what is the best price that he can? It's the price that basically optimizes the price times the demand at that price, of course, as long as it's no more than the total supply. So that's what the monopolist would do. And he chooses a price that maximizes his revenue for that day. So we're assuming the monopolist only thinks about today. Perhaps this is the only time he's going to be a leader, or the next time is very long in the future, which is sort of realistic. Okay, so then he decides the price. The block size is determined by the demand at that price, and we keep on going. Okay, so that's a very simple dynamic. So what do we expect to happen? Okay, so let's try to look at it. And let's just start with one example. And the example is, let's look at the uniform distribution. So bidders have values that are uniformly distributed between 0 and 1. So the demand at a certain price is 1 minus the price. All those that are willing to pay more than that. Right? That's the demand, that's a function, so that's the function that I drew here. And if you'll excuse me, I use like the way economists do it, so even though I'm looking at the quantity as a function of the price, I put the price on the y-axis. So I apologize for that convention. So basically what we see is a function q of p, which is 1 minus p, what corresponds to the uniform distribution. If you look at the market equilibrium, what happens at full efficiency? At full efficiency, we can sell everything because we have supply of 1. We can sell everything, and the price would be 0. That's no congestion, basically. So you have to sell at price 0, and you can sell everything. That would be like the socially efficient outcome. But if you actually calculate what is the best monopolist price, it's going to be at 1/2, and then you only sell half of the block. Okay? So that's, and then at least our leader gets some revenue of 1/4 rather than getting 0 that he would get if he really used all the block space. Okay, so let's see how this dynamic unfolds for this kind of distribution. So at day 1, as we said, we have no pent-up demands because this is the first day. And so our demand at day 1 is 1 minus p, the original function, to just what came, the new demand that came today. And as we said, the monopolist chooses the price 1/2, which is the monopolist price. So if we look, what is the new pent-up demand? So the new pent-up demand goes like this. At prices below 1/2, at prices above 1/2, we supplied everything. So the pent-up demand for tomorrow is going to be nothing because we supplied, we sold to everyone that was willing to pay more than 1/2. At prices below 1/2, it's basically going to be 1/2 less than the original, than the demanded today, because we supplied 1/2 of the demand, everyone was high. So basically what we get is the blue line that we see, that's a graph of the pent-up demand. As opposed to the red line, which was the original demand at day 1. Okay? And now if we want to see what would the demand be at day 2, well, it would be basically the pent-up demand, the blue line, plus the new daily demand, which is the red line. So altogether, it's like the purple line, that strange line that goes all the way to the right. So that would be the demand at day 2. So now we can, at day 2, do the same kind of calculation, figure out what is the monopolist price. And if you do the calculation today, now the monopolist price turns out to be 3/8. Okay? So it's going to be a lower price than yesterday. Yesterday, day 1, it was 1/2. Now it's going to be 3/8. So the prices are going down like we sort of wanted. And of course, the quantity goes up. Now you sell 3/4 of the block. Okay? And then you can do the same kind of tricks, compute the demand for the next day. So I'm not going to have graphs, but this is what happens the next day. The next day, the prices still go down, and the quantity still goes up. So it seems like we're on a good path to some kind of convergence at some value, maybe at a price of 0, maybe at a higher price, but things seem to be going well. But then on the 4th day, they don't go well. The price, if you do the calculation, the optimal price jumps up to 1/2 again. And if you do a simulation for, so this is discretized, but it's not because of discretization, that's really what happens, the prices keep fluctuating. And they keep fluctuating in a weird way. It's not the same, a nice sine wave or anything like that. You see that the values change, and sometimes you have a cycle with 4 rather than 3, which is the usual cycle. And that's reality. And this is for the very simple uniform distribution, nothing stochastic, no changes in demand, nothing at all. This is like an inherent property of this kind of dynamics. Okay? So, so can we analyze what happens in general? Okay? So we can analyze what happens in general, and this is with the analysis. So basically, and this analysis holds, I mean, the way it's written here is whenever everything is continuous and strictly decreasing, but whenever the monopolist price is not already the market equilibrium. If the monopolist really just wants to choose the best price, it really fills up the block space and everything is fine and there's no problem. But otherwise, this is what happens, whatever your distribution is. So there's going to be like a minimal price, which I call the serial monopoly price. And there is a formula for it, and it's basically the quantity of the monopolist times the price of the monopolist divided by the total supply. And the prices are always going to keep going down until this price. And once in a while, and the prices will continuously go down, never going below that price, a serial monopoly price. And once in a while, they will jump up all the way to the original monopoly price. Okay? So when they jump up, they will jump up all the way. And when they go down gradually. And however, as little as you are above this serial monopoly price, after a fixed amount of time, so the fix depends on exactly how much you're above this serial monopoly price, you're actually going to get a price, the leader price, to be below that, so your supply gets supplied, okay, within a finite time lag. And that happens whatever the daily distribution is, okay? So that's the theorem. So let me give you, I would like to say a few words about the mysterious parts, which are like the easy parts of the proof. So I can give you some easy parts of the proof, which seem to solve some mysteries. And I'll tell you what is actually complex kind of things that you need to analyze. So first of all, we're talking about, so this is like a price, set of prices. So the monopolist price is highest. The lowest price is the equilibrium price. And the serial monopoly price is going to be somewhere in the middle, and the formula was given as the product of the monopolist price and quantity divided by the total supply. So you can see immediately that it's less the monopolist price, and it's easy to see that it's above the equilibrium price. So the first question is, why can we not, where did we get this weird expression, and why can we never go down below it? Why is this the lower bound? So that's actually easy to see. If you go below that price, even if you sell everything, that is, you sell the total quantity available, which is S, then you're going to get a number below the monopolist revenue, which is P mon times Q mon. Okay, so of course you can never go down below that, because even if you ignore all the pent-up demand, just from today's new daily demand, you can get a higher revenue by going all the way up to the monopolist price. Okay, so that makes sense. This is why this is a lower bound for any price at any given time. The second question that we want to ask is, why do prices only go down gradually, and when they jump, they have to jump all the way up? Well, suppose that today the monopolist chose a price P of t, at day t. Now all the demand at prices above it is completely zeroed out. Okay? Only the demand below it is pent up for tomorrow. So if you look at the tomorrow's price, anything above the yesterday's price, basically, is going to be exactly like we ignore everything except for the new daily demand, because there's nothing pent up. And we already know that if you just do a monopolist price for the daily demand, you jump to the monopolist price, of course. So that's why either you're taking advantage of the pent-up demand and then you go slightly lower, or you don't, and then you have to jump all the way up to the monopolist price. So that sort of explains why there are these, jump up and then gradually go down, as we've seen already. So the main difficulty is to actually show that you get these oscillations and you actually never converge to anything, maybe to the serial monopoly price, maybe to somewhere above it, and that's actually the more difficult part of the proof, which I won't give you. Okay, so this was in the most simple setting with nothing stochastic, nothing changing, and yet you get inherently these fluctuations. And by the way, you can run this kind of simulation as an actual data. So I chose some 60, I believe, or 50 consecutive blocks from Ethereum, and just try to use this algorithm, what would happen in this monopolist pricing with the actual demand that we saw on the Ethereum. And basically, you can see, so the blue line is the base price, the orange line is the actual price with the average tip included. So there are a little bit of fluctuations, but not much. And you can see that the fluctuations you get by actually using a uniform price would be huge. Okay? So that sort of, is a strong argument, I would say, against using this uniform price kind of thing. Okay. So that's a bad news, I would say, if you're a uniform price enthusiast. But here is some good news. So if you recall, the thing that we were worried about most was that we were losing capacity of the system, that because we're not selling everything, we're losing a lot of capacity. So really what we should worry about is not just the capacity in terms of, TPS or gas per second. What we should worry about is the value lost. So if you calculate the value lost, okay, then basically it turns out that you can show that not too much value is lost. So you can prove that at most, half the value is lost. Okay, so if you compare this kind of dynamics and you see the total value of the transactions that were actually supplied in this dynamic, which is the green stuff, and you compare that to the optimal thing. Suppose that we always supplied everything that we have capacity for, which is the green plus the yellow stuff. The green stuff is bigger than the yellow, so we get at least 1/2. So that's something that one can also prove. So that, if you wish, shows that our main concern is not so bad. And by the way, of course, theoretically, whenever you prove a worst-case guarantee, like here with a factor of 2, in reality, for practical distributions, the gap is much smaller. For example, for the uniform distribution, you can calculate it. It's only like 6% loss. So there is a small loss in general, relative to, by the way, monopoly pricing, which can incur unbounded losses and, in fact, incurs significant losses even for typical cases. Okay. So now, these fluctuations, not only are they annoying by themselves, but they also actually put the whole point of view of thinking that users were myopic in question. So as long we argued that, if you're myopic, then, you're not going to affect the prices, you just tell the truth. But of course, if the prices fluctuate, you're not going to tell the truth. You're going to wait until the prices are low, especially as we see the fluctuations are very frequent. So it's less than a minute, let's say, in this kind of model. So you're going to wait this half a minute or so and wait for the price to go down. So then you will be strategic. You won't be bidding your real value, but rather you will be bidding a lower value, which, in a second or two, in a block or two, will let you get in. So how low will you be bidding? Well, you'll be bidding, let's say, the first round, something a little bit above the serial monopoly price, because very soon we're going to get to that price. Okay, so that's a strategic kind of consideration. But of course, once users start doing that, then the demand that the leader sees in front of himself goes down. So he's also going to decrease his price. And then the serial monopoly price will go down, and there's some kind of loop, and you can do this kind of equilibrium analysis. And at equilibrium, basically you get what you would expect. The equilibrium is at the market clearing price, like economists would generally accept. So if people are strategic, and there is a very strong reason for users to be strategic here, okay, then prices will go down to the market clearing price. And in that respect, it's sort of similar to a first price. That's what you would expect basically to happen just in pay your bid, because you're going to be strategic anyway, decrease your bidding, and the equilibrium will be when everyone knows what the market equilibrium prices are. So you sort of get this also here. But by the way, things may be a bit better here than in the first price, because once everyone else has sort of figured out the market clearing prices and gone down to market clearing, then even if you're not strategic, you still pay the correct price and not your price. So if most people are acting strategically, then the system is at market equilibrium price, and then I really don't need to worry. Only from my point of view, I don't need to be strategic. So things are a bit better than in the first price. I don't know if a bit better is good enough. Okay, so conclusion. So the conclusion is a bit complicated, so I don't have a nice conclusion. One thing that it's true, it's not easy to bid in a uniform price auction realistically, because you need to take into account the fact that maybe there are fluctuations. If everyone is myopic and really wants to go into this block or just is not smart enough to do this strategizing, then you get price fluctuations, which is bad. Of course, there's a good revenue gain, which is good or bad, depending who are you the leader or the users? And the loss of social welfare is not too severe. On the other hand, if everyone, or if enough people even have to act strategically, you're back to the usual market equilibrium prices, which is good, I suppose. And by the way, so this actually shows that you can do a nice analysis taking into account patient users across blocks, not only do mechanism design within a single block, and actually doing that for, let's say, the Ethereum kind of protocol would be kind of interesting. Although if there is no fluctuation in the demand, everything is fine, so you don't do anything new. So the interesting question would be to have a more sophisticated model with some kind of, I don't know, shocks in demand or something like that. And I don't know of good works along that line. So thank you.
Thank you very much for the amazing talk. I do have a quick question on the serial monopoly mechanism. So a nice feature of the EIP 1559 mechanism is this resistance against off-chain agreements or side contracts. And this is achieved because it somehow maximizes this social surplus. Yeah. So in this setting, the social surplus is not maximized necessarily. So do you think this could lead to a proliferation of these side contracts, or this is less of a very...
I believe that it should also be resistant to collusion of a single leader and users. Well, no, you could read it. I'm not sure about that, although that's not the part that I looked at, but I think that you're right that you can do some types of collusions, basically, where you're asking people to up their bids and then you're returning the money to them.
Yeah, there are lots of questions, please.
Hi, my question is, have you thought about doing a model from discrete and changing into continuous time? Because then maybe you can get some more tractable result using like delay differential equation or something?
I see. That's a good question. I have not done that. That's a very nice question. Yeah, maybe that would solve things.
Because then you can make the shocks like...
I see. That's an interesting question. No, I have not looked at that.
Okay.
Thank you.
Could you talk more? Yeah.
Good. So I will end on a low note and ask a stupid question. So since you're coming from Starkware, what if you add competition to your game? So I can either submit transactions to the mempool, or I can go through some accelerator, some scale layer 2.
So I think that the way that would factor out into this model is that basically would change your demand, right? So the price, so if I'm a user, if I have some alternative way to actually get my transaction, then that would be my value, right? So my value would not be really how much money I'm making from it, but rather my alternative, the cost of the alternative that I have, okay? So that's the way it would factor in it.
But isn't it like flight reservations? I have multiple choices.
Right, so I'm looking at the point of view from a single chain. I'm looking at everything outside of it. So I'm not doing the analysis of the competition between the different chains, right? Which is a different question, and I don't know how to answer that. But if I'm looking at only from my point of view of my chain, my blockchain, and the rest of the world is sort of fixed, It just gives like an upper bound on the value of that users have for their transactions.
But that also has limited capacity, right? It's not infinite.
No, it doesn't have to be infinite. It just has to be, you know, so as long as I'm not modeling how they work, they have some kind of pricing, and that's going to be my alternative price for my transaction. But you're right that it would definitely be interesting to actually model competition between blockchains also along the many consecutive blocks.
Well, one way to do that is with bridges. So you don't actually have to send your transaction to another chain to settle there.
No.
You just send it so that a bridge will relay it. And again,
that's even more
kind
complex.
Of like, yeah.
No, so you're right, but that's even a more complex modeling thing. So we have like an intermediate to complex modeling thing that I haven't looked at.
Right.
Hello, a short question. Does your analysis take into account that there is an upper bound on how many transactions a block can accommodate? Or
Yes, that's the supply. So it's not the number of transactions, but somehow the size of transactions, gas or something like that. And that was the number S that we had. There is a limited supply, and everything is with that limited supply.
Great, thank you.
Thank you.
Hi, what happens when the monopolist controls like several blocks? Maybe they're LiDAR, they control 40% of the blocks. They see some sequence of blocks that they'll control.
Yeah. Okay, so I haven't, completely analyzed it, but as one you would have said, once you start controlling more and more blocks, the closer we are into a classical monopolist situation, where he has more power, the prices are higher, the efficiency is lower. Okay, so I don't know how to exactly quantify, how quickly you deteriorate to a real monopolist setting. But basically, that's what would happen, I suppose.
I guess if you have like in the naive user model, you can like reset the cycle a little bit to try and push pent-up demand to your other like monopolist opportunities, right?
Yeah. So suppose that I now have a set of 10 blocks, right? Then I'm really a monopolist, right? So I want to take even higher prices because I know that pent-up demand will appear for the next one, and I'm the next one also. So I don't want to somehow reduce prices in the market.
Thanks.
Yeah.
Thank you. Let's thank the speaker again.